What's up, crew? It's Thursday, January the 14th, and today we're going to be talking about a potential new $3 trillion stimulus package that has been all the rage recently, what it's likely to include, how likely it is to pass, and what it means for markets, and a new focus of this channel, drumroll please, Bitcoin. I am Jonathan Smith, and thanks again for watching. First, on the brief today, there is a new jobs report that just came out, and this is the report, by the way, that comes out the first Friday of every month. It's published by the Bureau of Labor Statistics for the previous month. The Wall Street Journal headline pretty well sums it up, in my opinion. The U.S. economy ends 7 months of job growth, is what the article ran. Last month, the U.S. lost a cumulative total of 140,000 jobs. And this is, of course, attributable to rising virus cases and new business restrictions. And really, the most important thing about this number is that it shows, if you peel it back just a little bit, just how even things are right now. 498,000 jobs were lost in leisure and hospitality, but in other areas like retail factors and construction, those jobs are actually going up. So you really have a different situation where very different parts of the economy are having entirely different outcomes. Retail factories are interesting, in my opinion, because many are arguing that it is a likely indicator that people are shifting their spending away from travel and leisure to buying things. And buying things is a good thing right now, given that it increases the velocity of money into our economic system. Construction in particular is really interesting because of the bifurcation that we see. The cost of materials is way up. Tons of properties are being built. And really the interpretation is that people who are in a position to access this incredibly cheap money can take advantage of this moment, even as those who can't are stuck waiting for either government relief or a vaccine. Now, let's shift to our main discussion today, namely Biden's new stimulus plan that we will get clarity on a little later today if you are watching this video on January 14th. This plan will have important implications that all markets, including real estate and Bitcoin, will have to contend with. The word on the street regarding the Dems has been more stimulus focused on direct checks to people, the beginnings of universal basic income, and the idea that more direct checks to people means the potential for more growth and consumer spending, which means the potential for the increase of the velocity of money, which ultimately means more inflation. It started with Paul Tudor Jones, who wrote, quote, "We are witnessing the great monetary inflation, an unprecedented expansion of every form of money, unlike anything the developed world has ever seen," end quote. It was continued a few months later when Stanley Druckenmiller went on CNBC and said, quote, he wouldn't be shocked to see 5 to 10% inflation over the next few years, end quote. If you want to see a recent video I did on this very topic, you can click right here where it talks about how important inflation is and the impact that it could have on you. We got our first preview from Axios, who wrote a piece called Biden's 1-2 Stimulus Punch. Part one of the plan is to give people the balance of the $2,000 payment. $2,000 checks have become a meme over the last few months, aided in part by Trump, who said publicly that he was for it. So Biden's play would be to give people the additional $1,400 on top of the $600 that was approved last month. Part two of his plan is effectively just dusting off his election campaign plan that he called Build Back, Build Better. And that plan has two dimensions to it. The first is the allocation of billions for caregivers incentives, for manufacturers, bring jobs back to the US, and trillions for green jobs and infrastructure. The second part of the plan is how to pay for it, which is focused on increasing taxes on the wealthy. Specifically, the plan is looking to increase the marginal tax rate for top earners up to 39.6% from the current 37%, as well as treating capital gains over $1 million as regular income. The gains tax is easily the most contentious, and so I expect a lot of battles around that in particular. Now, as I mentioned, in some ways, this is a reversion. Biden, you'll remember, was initially projected to have a blue wave where he could have these ambitious plans buoyed by support in Congress and the Senate that obviously didn't come to pass exactly. However, with the Georgia elections, the Senate majority put a lot of these things back on the table. So then what are the questions? First, how willing are the Senate Republicans to work with the Democrats, or are they going to throw down and do everything they can to not let anything go through? Are they going to compromise? And if so, what are the lines that they can compromise on? There are some clear things that the GOP has wanted the Democrats to do, such as liability protections for business, fearing coronavirus lawsuits that could be used as carrots. What's more, infrastructure spending allows for a lot of pork barreling to be built in for people's home constituency. In other words, you get a little piece of that big overall money and you direct some projects for people and businesses in your community, and that makes you look good, even if overall you're saying that the plan is spending too much, yada, 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 yada. All that said, the transition we're making isn't just between parties, but fundamentally different governing styles. And it's not entirely impossible to me the Republicans will make it extremely hard to push this through. So then we come back to what the implications are for real estate and Bitcoin, and I think frankly that both are very interesting to me. On the one hand, there has been a huge narrative tailwind around Bitcoin's role as digital gold and an inflation hedge. Real estate has the same tailwind right now regarding inflation. This is literally what has been driving all of these new institutions into Bitcoin as a hedge against inflation. Inflation is something that takes a long time to show up. So as long as the expectation of the stimulus and spending is what they say it is, there's going to be a lot of room to run for Bitcoin and real estate. For the first time though, we are seeing something distinct in the real estate space. Namely, what used to be in the liability column, debt, is now moving over to the asset column. Let me explain. So it used to be that your property was in your asset column. An asset is something that puts money in your pocket. I know this is an argument. We won't get into it this video. And that your debt was your liability. But here's something that's very interesting that's happening. Right now, if you purchased a home or you refinanced a primary residence and you had relatively good credit and solid income, you were looking at a 2.5% 30-year fixed rate. Now, here's why that's important. If inflation, like Paul Tudor Jones said, and like I explained in my previous video on inflation, was somewhere around the 10%, that means that the dollar is losing purchasing power every year because as money supply increases, the value of the dollar decreases. What does that mean? Well, if you are locking in a home here at 2.5% and you have inflation at 10%, that means in 10 years, 15 years, 20 years, the value of a dollar is going to decrease, and yet your payment at 2.5% is fixed and is not going up. So now what many people are saying is that this home is now going into the liability column and your debt is going back into the asset column, or it's going into the asset column for the first time simply because there is a wealth transfer when you consider the delta between your 2.5% rate and then your 10% inflation rate. Who makes up the difference of the 7.5%? Well, many are arguing now that there is a transfer of wealth happening as a result of this problem of inflation, and that you can now lock in a 30-year fixed mortgage rate at 2.5%, which keeps you there for 30 years, even though the dollar in 30 years wouldn't be able to purchase the same house. And so for the first time, we're seeing real estate, even more so than in times past, be a hedge against inflation. And now the debt is actually moving into the asset column because in the long term, it's putting more wealth into your account and more wealth into your life. It's an interesting development to see here and something that we're going to be tracking specifically. So I believe one of the two most important narratives being worked out in 2021 will be Bitcoin and real estate as a store of value and a protection against our currency being degraded, but I'm curious, what do you think? Let me know what you think in your comments below. Give me a thumbs up or a thumbs down. Like the video if it was helpful for you, or consider sharing with someone you think might benefit from it. And thanks again, folks, for going on the journey with me. And until the next video, I'll see you then.